Today, I want to jump into one of my favorite topics, and that's building a long-term investment portfolio using only ETFs. So, most people know that investing is the way to go, but not many people implement it the way that it should be done, right? They have this common misconception of that you just buy a couple good stocks, you hold them for a while, you make some good returns, and that's what it's about. See, that's simply wrong because most people just buy stocks with no actual analysis behind it of why they're owning a stock. Now, when I say analysis, I don't mean just buying the stock based off of, oh, the key levels here, it's doing this, it's breaking this. No, no technicals. I'm talking about pure fundamental analysis by breaking down balance sheets, breaking down cash flow, determining their intrinsic value, determining the company's long-term sustainability, and all much deeper questions that you need to determine for yourself to understand why you're owning a specific company. So we're going to jump into this video and really dig to the depths of why owning ETFs is the best way to passively invest for the common investor that doesn't want to dig down and do all of this nitty-gritty research, right? So let's jump right into it. So today what we're going to cover is what are ETFs, why choose ETFs over individual stock, and how to diversify a portfolio using ETFs and dollar cost averaging and why everyone should do it. So let's jump into slide one. What are ETFs? So before I jump right into it, I want to let you guys know some of this stuff that you're going to see is actually quoted from my book that I recently wrote. So I'm going to drop a link in the description below if you guys are interested in that. So some of this stuff may seem like it was pre-written, which it was. It was from my book. So again, let's jump right into it. So an ETF stands for exchange traded funds, which is simply a basket of securities that are traded on an exchange and are bought and sold the same way as stocks. There are a variety of different ETFs that track different markets, such as sector ETFs, index ETFs, bond ETFs, real estate ETFs, commodity ETFs, currency ETFs, equity ETFs, and more. These funds allow you to trade or invest in a diversified way. For example, if you like to trade stocks in the S&P 500 rather than picking individual stocks, you could simply trade the SPY ETF. When you buy a share of SPY, you purchase a piece of the entire S&P 500, which gives you ownership to the fund's holdings. Now, we're going to look at some examples of ETFs and their holdings. So if you wanted to trade or invest into an index ETF, you could trade something like or invest into the SPY, the QQQ, or the Dow Jones ETF, the DIA, right? So now listed below are their top holdings. Now there's many more holdings in these funds, but these are the top holdings, right? So now these are the S&P 500 11 sector ETFs that break down the S&P 500 into the 11 sectors that it holds, right? So if you want to invest into only, let's say, the communication service sector, you can buy the XLC ETF. If you wanted to buy just consumer discretionary, that holds Amazon, Tesla, Home Depot, McDonald's, all these consumer discretionary companies without actually having to buy the whole S&P, you can do so as well. So going forward, these ETFs that start with X for the select SPDR State Street Global Fund ETFs. These are their specific ETFs. All of these ETFs that start with X, right? So moving forward, we could see, boom, three more. We got the XLRE tracks real estate, XLK tracks technology, XLU tracks the utility sector, and now these 11 that we just looked at all track the S&P 500 in individual sectors. Now, if you didn't want to buy an individual sector, again, you can go back and just purchase the SPY, which tracks the entire S&P 500, right? Okay, so now moving forward. Okay, so now let's look at examples of equity ETFs. So if we're looking at the VTI on the left side of the screen, that tracks the total stock market, right? So by purchasing one share of the VTI, you own a little piece of the entire stock market. Everything that is in, every stock that is in the stock market, you own a piece of. You name it, you own it. Every single stock. VOO tracks the entire S&P 500, right? So when you buy VOO, it's exactly the same as SPY. It's just under a different fund's portfolio, right? So a different fund runs that ETF. Now VT, these three, by the way, are all Vanguard ETFs. So moving to VT. VT tracks the total world stock market. So if you wanted to just purchase every stock in the whole entire world, I'm talking about United States, I'm talking about every single country, every stock in the world, you purchase VT. And now you own a percent ownership of every single stock to exist. All the shitty ones, all the mid ones, all the high-end ones, every single stock. Now, if you wanted to diversify your portfolio with a foreign ETF, such as VXUS, this tracks the total international stock market. You get access to all the international stocks that are overseas. Now, with the real estate ETF, VNQ, this tracks all United States real estate. Now, there is another VNQ ETF that tracks specifically international real estate. I'm not sure what ticker that's under because I don't track international real estate, but that is an option if that's something that you're into. Now, the bond ETF, which is BND, for those that aren't experienced bond pickers such as myself, I don't want to have to look through all these bonds, treasury notes, all this different stuff, the 2-year, the 10-year, the 5-year, to break down what fits me. So what do? Instead, I buy the BND, which tracks the total bond market. By buying the BND, you get access in a diversified way to all different types of bonds, right? So now moving forward. Why choose ETFs over individual stock? So, investing or trading ETFs is ideal for those who are not inclined to pick individual stock winners consistently based off fundamental analysis, which we spoke about before. Fundamental analysis, in simple terms, is the art of evaluating any business by getting an accurate picture of how financially healthy and sustainable it is. It involves studying a company's potential for future growth by considering various micro and macroeconomic factors and determining its intrinsic or real value. If you do not know how to go about this process or have no interest in learning how to do so, ETF investing is by far the safest and most reliable way to go. Instead, you can invest into the overall strength of an industry group, which takes away the risk of being exposed to individual company risk. If you are only holding, let's say, stock ABC, which is a tech stock, but you're not sure why you own it, you just believe they have a bright future, and now negative news comes out and they're going bankrupt. For whatever reason, you'll be exposed to 100% of the risk as opposed to investing in the SPY or the QQQ, which wouldn't have as much of a negative effect on your holding because the ETF you own is diversified through many different companies. Of course, this is assuming that stock ABC was a part of either the NASDAQ or the S&P 500. Now again, why choose ETFs over individual stocks? It is important to note that investing in ETFs comes with minor fees paid annually to the fund for doing the work of adding or replacing securities that the fund holds to ensure its top-notch performance, which is why it is crucial to invest into low-cost funds. When I say low-cost funds, I do not mean low cost in share price. I'm referring to low cost fees such as 0.05% annually, such as those offered by Vanguard and many other great institutions. I personally am a fan of index funds which track the overall growth and conditions of the market. I use these funds to build a long-term diversified portfolio without having to individually pick what stocks will perform well over the long run. It's no secret that markets go through cycles, meaning industries that perform well this year may not perform the same next year as market conditions are forever changing. Picking individual stock winners is a losing game. Unless you have knowledge on fundamental analysis and have done your homework thoroughly and hold a solid conviction in a decision for many reasons why, even then, you should still be cautious and allocate a small percent of your total capital to one individual stock. These ETFs are a perfect choice for the passive investor that plans to invest using a strategy known as dollar cost averaging, which brings us to the next slide. Great. So, dollar cost averaging and why literally everyone should do it. Dollar cost averaging is an investment strategy, which is when an investor divides up the total amount he plans to invest over a specific period of time to reduce the volatility of the purchase rather than purchasing all the shares at one price. The idea is to purchase the asset regardless of the price on a consistent basis. The purpose of this strategy removes the need to time the market, which is a mistake many investors make when attempting to commit to an investment. The investor often procrastinates in purchasing their investment due to believing the market is too high and rather wait until prices come lower, which often impacts overall returns. Dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed by purchasing all your shares at the top. It's nearly impossible to time the market top or bottom, which is why dollar cost averaging is the best strategy for passive investors. This strategy can be implemented regardless of your knowledge on markets. The idea here is to pick an asset class or classes you would like to be invested in over the course of many years. Decide on a dollar amount you would like to allocate to the investment. Divide the total dollar amount by the amount of months you plan to acquire the entire purchase. Consistently purchase the dollar amount of shares each week or month, regardless if the price is higher, lower, or the same. Let's see how this would mathematically play out. So when implemented, dollar cost averaging looks like this. Let's say we plan to invest $10,000 over a 12-month period, right? That's the 12 months divided by $10,000 is $833 a month. So no matter what, let's say the share price starting off is $100. We're going to consistently invest $833 a month into, I don't say, ETF ABC, right? Into ETF ABC, no matter what the price is. So let's say month one, the price is $100. We're going to invest $833. It buys us X amount of shares. Now the next month, it's 85. We invest the same amount of money. It buys us more shares. And now the next month, again, we continue to repeat this process all through the 12-month period, regardless if the share price is up, down, or the same. And mathematically, it works out by averaging your price to the median number. So by the end of the 12-month period, if we look, the total shares that we've acquired by doing this is 94.35, right? So about 94 shares we've acquired, and the average price we paid was about $106, right? At the next slide. After implementing dollar cost averaging by purchasing a set dollar amount on a monthly basis, we arrived at an average purchase price of 106. Even though we purchased some at a higher price and some at a lower price, we did not need to time the market. You might be thinking it would have been more efficient to purchase all your shares at one price to make a larger profit, and you'd actually be right. But the purpose of this strategy is to ensure you do not purchase all your shares at a potential bottom or top, which could be costly if price does not move in your favor. So all in all, ETFs are a great investment vehicle to build a long-term diversified portfolio within different asset classes and to compound slow and consistent growth, which requires patience and discipline to do so consistently year after year. So in the next section, we're going to discuss portfolio diversification to give you a solid framework of how to build an ETF portfolio using the dollar cost averaging strategy combined with ETFs that we've previously discussed. How to diversify a portfolio using ETFs. Everyone's investment goals will vary from person to person based on risk tolerance and length of investment. The examples given are generalized as suggestions and not exact percent allocation. What may be efficient for you may not be good for someone else. So here's 3 portfolio examples. We're going to look at aggressive, moderate, and conservative. So with the aggressive portfolio, we're going to look to hold 50% stock. Right now, when I say 50% stock, I don't mean individual stocks such as a Tesla, Amazon, Microsoft. I don't mean that. I mean the equity ETFs such as the VTI, the VOO, right? Stuff that actually holds stock in the fund. So with that being said, we can hold one of those ETFs, let's say VTI, in the 50% portion. In the 20% portion, we're going to hold bonds. Now, instead of, again, individually picking bonds, what we're going to do is we can hold the BND ETF, which is the total bond market ETF. Gives us exposure to the whole bond market. Now, with the 30%, these are alternative investments. Now, what are alternative investments? These are investments that are obviously not stocks and obviously not bonds. What are they? They're international stock ETFs, they're emerging markets, developed markets, commodities, precious metals, real estate, right? Stuff like that. Those are alternative investments. So with the aggressive portfolio, that's going to be 30% of the portfolio. Now, I want to say one thing before moving forward. These percents that we see in the pie, they don't have to be exact, right? They're never going to be exact because you may want to be maybe a little bit more aggressive with stock and maybe be 70% stock and maybe 20% alternative investments and 10% bonds, right? that may fit your criteria a little bit better. This is more of, like a general guideline for a roundabout how the portfolio should look, if it's aggressive, moderate, or conservative. So with that being said, moving forward to moderate. So with the moderate, we're going to look for 30% stock, 20% alternative, 10% cash, and 40% bond. Now, why are we going to hold cash and 40% bond? Because stocks are 3 times more volatile than bonds. So if we're holding 50% in our portfolio of stocks, our portfolio is going to be very volatile. But now if we drop it down to 30 and we up our 40% to bonds, those bonds and that 10% cash, which makes up 50% of our moderate portfolio, is going to make our portfolio much less volatile and be able to withstand market corrections, crashes, recessions, stuff like that, right? Because only 30% is stock and 20% is alternative investments. And now keep in mind, I'm going to go over this in another video because it's a lot to cover here. That 20% alternative investment could be an inflation hedge, a recession hedge. It could be some type of investment that can actually benefit your portfolio in times of, distress in the market. So with this being said, this moderate portfolio is actually somewhere in the middle, obviously, of being aggressive and being conservative. This is for someone who's not really a risk taker, but they still want to make their returns, but they don't want to be on the very conservative side either. So now moving over to the conservative pie, this I don't really recommend for people who are young and really have a long time horizon to invest. This conservative portfolio is more so for someone who can't really take on risk because they don't have the extra cash, or someone who's really coming up upon retirement and really doesn't want to take on that extra risk because they don't need to, right? So with the conservative portfolio, we're really looking at 40% bonds, 30% cash, 15% alternative, 15% stock. So now, if we really break this down, 70% of the portfolio is really kind of standing still because the bonds don't really move, right? We're getting paid an interest rate on that, which is called coupon rate. The cash obviously doesn't move, and only 30% of our portfolio is really actually active moving around, right? So moving to the next slide, these are some examples. Now, if you wanted to break down the 30% of the aggressive portfolio with the alternative investments, we could choose VNQ, which is real estate, VXUS, which is international stock. Now, again, I want to mind you, even though I used the same exact selection for each, there's a variety of different choices you can use. Like I was saying before, for the alternative investments, you could invest into international stock. You can invest into emerging markets, developed markets, precious metals, commodities. There's so many different types. But for the purpose of this video, I wanted to keep it very, simple. So now, underneath that, we have VT, which that's actually a typo right there. VT is the total world ETF, which still falls under the stock category. It's just the wrong ticker symbol for the S&P 500, which should be VOO. So now underneath that, BND, bond market, would fall under the 20% of the aggressive portfolio category. Moving next, we could see how each correlates with the way that the portfolio should be set up. And now again, I want to reiterate this again because it's very important. The portfolio isn't going to be the exact percent allocation. You may want to up certain things a certain percent, or you may want to cut down certain things a certain percent. It's all relative to your goals. Now, last but not least, in the last 3 previous examples, the 3 types of diversified portfolios are not limited to those ETFs I use as examples, as I just said. There's over 8,500 ETFs in the world to choose from, although you do not need more than a handful to obtain a diversified portfolio to fit your investment goals. If you want to invest in individual sectors within the S&P 500, you can also add the SPDR Select Sector ETFs, which we discussed earlier in the slides, to get exposure to the specific industries in the S&P 500 without having to invest in the whole S&P 500. Now, it's important to remember that over-diversifying actually exists, and it can be counterproductive to your goals. So I will be doing another video on types of investments to include in your portfolio to protect against inflation, crashes, recessions, by using different investment vehicles such as precious metals, tips, bonds, and inverse ETFs. So I really hope that you guys gain some value from this video and you can actually implement it into your investment portfolios. So with that being said, I'm going to end off here. Thank you guys for watching, and I hope you found some value. Take care and have a very good trading week.